So welcome back. Today I've got Jason Smith with me from Capital Plus Finance. Now you may be familiar with Jason from some of our earlier episodes and some quite popular ones on business funding. But I'm going to put Jason in the hot seat a bit today because I've got a burning question that's been coming up from a lot of the clients and business owners that I've been talking to. That's about business credit cards. Are they a good thing or a bad thing, or is there something else? And I've got a feeling that Jason's going to say, hey, there's a better discussion we need to have than just talk about credit cards. So, Jason, welcome back. It's been a while.
Thanks, Paul.
It
has been a while. It has been a while. We even had to change my my profile picture because it could have been construed as false and misleading advertising from when we did it about 4 or 5 years ago. But no, good to be back. Business credit cards. I don't have one. I don't like them in general. I think it's really important to have obviously separate your personal expenses from your business expenses, but I think you've got to think long and hard before you get a business credit card. I don't know of any banks that don't charge upwards of 20% for them, and usually an annual fee as well. So personally, I'm not a fan, but I do understand there is a place for them, for businesses to have them. Would strongly suggest that businesses use them as a debit card, and that is, or a charge card, so that they're not paying the minimum amount of repayment each month. And they just knock it over.
Mm-hmm. So I get this question about, well, shouldn't I be trying to get points as a business owner, and what's the value of those points? And there's a big problem that I have is that often, particularly in this startup phase, new business, you're spending money that you don't actually have. And the question is really, should you be spending that money? Should you be investing in those resources that you're not in a capacity to pay for at this time? Are you better off using that time and resource to actually grow your business in a different way?
Look, I agree. I just don't. I might be a little bit conservative on this. I've been a business owner for a long time, but I would, strongly suggest not spending money that you don't have on a business credit card. I think do it if you absolutely have to, but that would be about it.
Mm-hmm. So that, we often hear stories about people who have bootstrapped their business using multiple credit cards, and my view is that that's just leading to a waterfall disaster that's about to happen, and you're just pushing it off. So you've really got to establish your revenue pretty quickly and bring those balances back to zero. If you're paying them on time, well, I guess there's no disadvantage. But often with those business cards, you're paying a premium annual fee as well, and often a card fee per user. So they do tend to add up quite.
Well, they do. They do. And that's when I think I was paying $100 a year for each user on my credit cards a few years ago. I just thought, well, I haven't used this. I use my debit card, obviously, but I hadn't used it, so I got rid of them. I don't want to. I know it's only $100 a year, but I don't want to pay. I don't want to give the bank $100 a year for something that I'm not using. And you talk about points, and look, there's plenty of people out there that have hundreds of thousands of points that they can use to travel overseas, upgrade to business class or free economy flights, which is getting more and more difficult to do, particularly through Qantas. But it just comes down to the fact that, do you really do that if it's a charge card? So if it's an Amex or something like that, you've got to pay it back at the end of the month. Maybe do that. Now, I've got a few points from using an American Express card in my business, but never would I use a business credit card to accrue points and run the risk of paying that a day late, paying those penalty fees, or being in a position where you can't pay it back.
Yeah. So business credit card, not a great report card from us.
I don't think so.
Yeah.
And look, the other thing I just want to touch on briefly is your credit report will show if you paid that credit card late. And there's nothing more that will destroy your score quicker than paying your credit card 15 days, 30 days, 45 days late.
Okay. Yeah, so there's some traps there.
Definitely. People don't understand, I paid 30 days late, it's okay. No, it's not okay. It gets reported. Most of the major banks report it to Equifax, the major credit reporting agency, and you get a 1, a 2, or 3, and as soon as you see that, the repayment history is adverse, and your score just goes down significantly.
And then that's got implications in terms of, I guess, more important borrowing opportunities for the business.
Yeah, absolutely.
So alternatives to credit cards. So one is
have the cash available before you spend it. I've just recently become a bit of a fan of Profit First from Mike McCallowitz, and I've probably said that name incorrectly. But this whole idea of not spending money you don't have, but also making sure that when you get your revenue coming in, you're setting aside the profit, you're setting aside those key expenses into separate buckets, or whether that be separate bank accounts, or ideally separate bank accounts. So that money is reserved from your revenue, reserved to pay those expenses as and when they fall due, which is a great strategy. And I think the thing that really caught me when hearing about this for the first time is introduced by talking about the size of dinner plates back in the 60s being 8.5 inches, I think it was, whereas they're now 11.75. But people still think they have to fill the whole dinner plate. So most businesses operate that they've got the whole dinner plate and they can spend the whole lot. Whereas if you take a smaller dinner plate as what you're going to spend and use the rest as your profit and set that aside, you tend to be a bit more mindful about where you're spending and a lot more cautious about just pulling out the card or even the debit card and paying for stuff that you don't really need.
That's right. Yeah. So let's face it, we're collecting that GST, and I bet most Australian businesses do not have a tax account.
Yeah, I rarely see a tax account. I rarely see a business now with more than one bank account, and everything is going through that account, and there's nothing being set aside. So often a business owner might look at it and say, hey, I've got 50 grand sitting in my bank account. I need another 10 or 15. It'd be lovely to put that off and pay for my holiday. But what they haven't allowed for is the GST. They haven't allowed for the super guarantee. They haven't allowed for PAYG withholding.
Yeah.
And then all of a sudden, then they've got this shortfall and they can't pay the tax when it falls due, which then opens up another issue with issues with the ATO and perhaps a director penalty notice being issued.
Yeah, and nobody wants to get one of those. And that I don't want to go too far off topic here, Paul, but what we're starting to see now is the ATO is back on director penalty notices. So if you're not in a payment arrangement, you're not communicating, you do get a director penalty notice and you are personally on the hook for that tax debt, as I'm sure you're advising all your clients of. But what they're also doing is putting it on your credit score. So what we're starting to see now, don't communicate with the ATO, don't enter a payment arrangement, a default goes onto your credit report. And that has the same implications as not paying your credit card. And it just says quite clearly there, ATO default and the amount of tax that you're owing.
Yeah, and that's not a good outcome. If you want to find out a bit more about what you need to do if you do receive a director penalty notice, then I encourage you to go back and listen to the episode we had with Bruce Gleeson from Jones Partners, where he actually outlined what is a director's penalty notice and what action you should be taking when you do receive one. So that would be great to get back to. So, Jason, let's get back on topic. Let's no to credit cards, pay things on time, but when you do need to fund your business, what are the best options?
So there's a few options. There's some really good options out there now, and there's some really bad options. Business loans are a massive industry now in Australia. There's probably over 20 different lenders. So these are companies, big and small, who are non-bank lenders. And look, most small business owners would be aware of them. They're non-bank lenders. It's fast money into your account based off a matrix system, and it's usually your bank statements that they're looking at. So they're looking at the cash flow of your bank statement. So you've got a scenario, you go to NAB. I'll pick NAB because that's who I bank with, and you say, I'd like a business loan. Their turnaround time, if you don't have a business banker, which most small businesses don't, would probably be 6 to 10 weeks. And 6-page forms to tell you, we can't give you a business loan, or how about we secure something against your property. As we know, banks have a love affair with bricks and mortar, so they want to know that you're a property owner. Not all business owners are property owners. So that's one option. The other option is you talk to a broker, or you talk directly to one of those business loan specialists. They look at your bank statements, they assess you, and you've got money in your account usually within 24 hours to 48 hours. So it's a really quick sugar hit, which is a good thing and a bad thing. So it's very simple for businesses to get access to funds if they've got a good credit score, if they've had an ABN that's been around for probably more than 6 to 12 months, and if they're property owners, that's even better. So the good thing about that is that there are some really reputable lenders out there that have very competitive interest rates, They're completely transparent with how they do business and how their contracts are set out. And you get funds fast. And what you've got to be really careful of is a lot of these business loans are very short. So they amortize really quickly. So you might borrow $50,000 and you're paying it back in 6 months. Now, if that interest rate's too high, you're actually borrowing money to pay back the money. That's all you're doing.
Right.
And I see that in really badly quite often. And without sounding too controversial here, at the bottom end of the spectrum, you've got lenders who will do it at an annual percentage rate of about 14.95%. That's at the better end of the spectrum. At the worst end of the spectrum, you've got lenders who I would definitely put them in the category close to lenders of last resort, and they'll put out money at 75, 85% per annum.
Gosh.
They don't put that on the contract.
Yeah.
That doesn't go on the contract. You borrow 50, you pay back 65, 70,000. If that's over 6 months, that's what that annual percentage rate ends up at. So it really is a bit of a, it's really hard industry to navigate because they're so good at their marketing. Well done, but they're really good at their marketing. And a lot of business owners just fall into the trap of borrowing money and then redrawing money. So they're just borrowing money to pay back money. So so look, on one side, you've got non-bank lenders with low interest rates, and some of them even have an overdraft facility or line of credit facility, which is great because you're using it, that cash when you need it, you're paying that cash down. You're only paying on what you use. But the other category, which unfortunately sometimes brokers really push because the commissions for the brokers are so high, has devastating impacts on businesses. I've actually never seen it end well for businesses. If you're borrowing money at 90% per annum, sometimes over 100% per annum, you're going to end up, you're going to be screwed.
Okay, so it seems like it's very easy to choose the wrong product as a business owner. And look, business owners are often really busy with what they're doing, and there's a lot of things going on. So it seems to me, ideally, they should be talking to somebody like yourself, a broker, actually looking at who understands the products, understands the business, and can match the right product with the right scenario.
Yeah, look, absolutely. If they don't have the time to go to the different business loan lenders themselves, you get a broker involved, somebody who's been referred to or you trust or you've used before. Sometimes I do a lot of asset finance broking. So you think of what I do is I do anything but mortgages, anything for a business or a consumer other than mortgages. So although we do a lot of vehicle finance and truck and trailer finance, we have a big part of our business that knows exactly what's happening out there in the business loan market because it is so popular. So you need to find a broker that you trust who's going to look after you, is going to steer you towards who's the best lender for you. And that generally comes down to who's going to have the cheapest interest rate. That's generally speaking. No hidden fees, that type of thing. You can pay it out early without any penalty fees. That's what a good broker is going to look at for their customer.
And, somebody who has got themselves in a little bit of trouble, perhaps by paying their credit card late, not sure what to do. That credit rating, how does that impact this process?
It impacts it massively. You can forget about it. If your score's under 500, you're going to the lenders who are going to charge you significant interest rate, which is more than likely just going to compound your problems. So my caveat there is that if you've got an opportunity in your business, if you get a chunk of cash and you've got an opportunity in your business to turn $50,000 that you're borrowing at a really high interest rate into $100,000 or $150,000, then you've got to go for it. But if you just band-aid, putting a band-aid over problems that you have in your business, whether it's tax or whether it's working capital or things like that, you've got to think long and hard about what's going on. Because I'll go as far as to say that in the insolvency notices that come through, I'm not sure if you get those from different insolvency practitioners, you'll see particular lenders where that customer, that business has gone into insolvency and who the person has put them into insolvency. And there's a bit of a track record there of who the lenders are. And there's lenders in finance. I'm getting a little bit more controversial here, but why not? in finance, most brokers work through an aggregator, and there's lenders. An aggregator is just somebody who puts all the lenders together. So we've got Westpac, BOQ, Abbott, ANZ, Metro, and all these different asset finance lenders and business loan lenders. There's lenders that want to get on our panel, the aggregators panel. They'll never get on the panel. They'll never get on the panel. You can't get on an aggregators panel and charge that sort of interest rate, no matter how poor the customer is.
So education is key here, and understanding. So what's the first step that somebody should take when they're looking to finance?
Look, do your research. Just find a broker. And if you don't want to find a broker, don't go submitting inquiries through AI, lending systems online, because it'll just hit your credit score. So you just have an inquiry on your credit score. It might be a yes, that's great. It might be a no. It might not be the best rate. It might be the worst rate. So I think the first step is going, what do I need these funds for? And look, I've got to tell you, as a finance broker, we're not really there to advise our clients, but we want to make sure that they're doing it for the right reasons. So if they want 100K and that's what they need for their bringing some goods from overseas, or to they need more working capital because of their debt turn or whatever might be going on with their business, we'll ascertain that. We'll look at their bank statements for them, and we'll assess. We'll workshop with the lenders out there which is the best way to go, and then we'll come back to the customer and say, well, this is what we can get here, and this is what it's going to cost, and then leave it up to them.
Yep. So, what are the steps that you would advise somebody to do before they even think about borrowing? Do the banks look at cash flow forecasts or plans?
If we're talking about business loans, it's all matrix based. There's a few lenders out there that will think about acquisition. What's the cash flow forecast? What's the opportunity? Is there a work source letter with the work that's upcoming if they're in a particular industry? Most often, it's about how old's the ABN? Are they a property owner? And again, you can get a business loan without being a property owner. What's their credit score like? And what are the bank statements telling us? How much? And this is not PDF bank statements they're looking at. This is software that all the banks use and all the lenders use through. Most of them use it through a company called Ilion, which I think used to be done at Bradstreet. And it's just assessing what's coming in, what's going out, and it categorises everything. And so that's what's really going to decide whether or not somebody's going to get a loan or not. Unfortunately, not the business plan and not the cash flow forecasts. That's on a high level. They start to think about things like that. The banks do anyway.
Yeah. Okay. Okay, that's good. So, not to say to our listeners that you shouldn't do your business planning and your forecasting, because that gives you an idea of where you're actually heading with it and gives you a good idea. But okay, so the banks aren't looking at that, particularly if we're in this situation of having to fix a credit drain.
Yep.
Yeah. So, okay, let's assume that somebody's starting without any credit card history, without any issues with lending. Everything's going well. They've been paying for everything. You mentioned, tools about or facility to help with acquiring, I guess, stock or materials to help with a large sale. What sort of options are they? Because they seem a bit different to your traditional lending.
Yeah, look, they are. Look, so your business loans fix a lot of holes in businesses if they want to do something, if they want it quick. Trade finance is another type of lending that they could utilise if they're bringing in stock. If they want to pay suppliers locally, or if they're bringing in stock from overseas. There's plenty of trade finance lenders out there. Debtor finance, which I think we've talked about before, Paul, I can't remember. Still the best kept secret in Australia, but it's basically funding your unpaid invoices. And they will generally, not as quick at fix as business loans, but they will look at your ledger, your outstanding invoices on your ledger, and they'll fund a percentage of those invoices. So if you're getting paid 30 days net or 30 days end of month, and you might have 100K or 200K or 300K locked up in your accounts receivable, they'll fund a percentage of that. Okay, that's a once you've got that set up, that's a really good way of funding the future growth of your business. The one thing I do like about that is you're not spending money you haven't earned.
Yeah, and that's a crucial thing that's coming out, and we're hearing that a lot more these days. If you're listening to podcasts, watching some of the key people, don't spend money you don't have is one of the keys. You can avoid that financial situation if you are not spending money that you don't have.
Yeah.
So,
yeah, it's pretty straightforward, isn't it? A bit harder to do.
Well, they say that business is simple, but doing it is the hard work.
Yeah.
So,
yeah. Well, even just having those separate buckets you talked about, it's critical. In Australia, we collect all the tax. We bring in all the tax, and when we pay our wages each week or each fortnight or each month, we're not paying the PAYG withholding. We're not paying the super. That comes at a later point that you've got to pay that at the end of the quarter. It's just critical that you have those three key things put aside.
Yeah, absolutely. Well, okay. So, Jason, look, summarising our discussion today, I think the first one was easy. Business credit cards are a no. What are the key points that you'd like our listeners to take away from today's discussion?
Look, try and stay away from points and business credit cards. If you do need a business loan, make sure you do your research. Get a broker involved if you really need to get a broker involved, and make sure you're getting the best deal out there. And just knowing why you're getting the business loan or the overdraft. I am keener on overdrafts than a business loan because you're more in control of it with an overdraft. And the third thing I'd like to say, which we haven't really touched on, is just know the difference between simple interest and the annual percentage rate, because it is massive. Okay, and the larger business loan lenders out there have a system where they're disclosing what the annual percentage rate is, they're disclosing what the simple interest rate is, and they're disclosing what the factor rate is. And it's called Smart Box. And they all joined this concept a few years ago so that it's nice and transparent that people can see what it's costing them. Some of the other lenders don't do that. That's fair enough. But you've got to know what it's costing you. So just quickly on that, if somebody says this is a 10% simple interest rate, so that sounds good, right? 10% interest, you borrow $100,000. At the end of the 12 months, you pay back $10,000. That sounds like a simple interest rate of 10%. It's not. It's about 19 to 20%. Okay, that's what. So the formula for figuring out what a real annual percentage rate is, which is what we all see with our mortgages, that annual percentage rate is what we've got on our mortgage or what we've got on our car finance, is doubling the simple interest rate. And the reason for that is that there's these fees and expenses that the simple interest rate doesn't take into account. And it doesn't take into account that every payment you make, you're reducing the principal of that loan. So it makes a massive difference. That's where I talk about those other lenders where they might say, it's a factor rate of X. You borrow 50, you pay back 65. People think, that's okay. When you work out the true cost of that as an annual percentage rate, it's not okay. So just be aware of that. Find somebody who's aware of that. Google or whatever, but just know what it's really costing, because most people don't want to pay an annual percentage rate of 40, 50, 60%.
I don't think anybody would if they were aware that they were paying it. Yeah. So, look, I'm going to go one step better and say, don't Google it. Contact Jason because he knows what he's doing. He knows what he's talking about. He's been dealing with a lot of small, medium business owners, helping them get great results with their finance. So I'm sure Jason would be happy for you to get in contact with him at. So what's the best way, Jason?
Look, just give me a call on the mobile. It's on LinkedIn. Go to our website called the 1300 number. But look, all my details are on my LinkedIn profile. And yeah, it'd be great to have a chat.
Fantastic. And we'll share Jason's contact details in the show notes for you to look up. And make sure you do get in touch and talk to, if you're not talking to Jason, talk to a broker before you go and make those applications. So thanks again, Jason. It's been great having you back on the podcast, and we look forward to some more discussions in the future.
Good on you. Thanks, Paul.